it's important to evaluate monetary policy and fiscal policy in the post-reform period and pre-reform period. In the pre-reform period, the monetary policy was generally accommodative to neutralize the shortcomings of fiscal policy, but in the post-reform period, the emphasis and the dynamic have changed radically to aggressively input monetary policy on its own and just not adjusting flexible fiscal policy, but monetary policy itself has tried to create aggregate demand, and counter deflationary pressures are also very important during this period. To quote C. Rangarajan, the former governor of the Reserve Bank of India, I quote, "Until the overall reform process was initiated in 1991, the basic goal of monetary policy management took the form of compensatory increase in the CRR for banks, controls on the growth of commercial credit mainly to the private enterprise sector, and adjustments of administered interest rates. The fixation of CRR and SLR at their maximum levels crowded out credit for the commercial sector. Thus, even when money supply was growing at a rapid rate, the private sector could not get the needed credit and for financing industry and trade." This was the observation of a well-known accomplished monetary economist and former RBI Governor C. Rangarajan. Explaining the monetary policy adopted prior to 1991, Dr. Y.V. Reddy, another former governor of Reserve Bank of India, has written that, I quote, "Given the command and controlled nature of the Indian economy, the RBI had to resort to direct instruments like interest rate regulation, selective credit control and CRR as the major policy instruments. These instruments were used to neutralize the monetary impact of the government as budgetary operations. In the recent post-reform period, mainly during 2008 and 9, accommodative nature of monetary policy to the government's fiscal policy has been significantly noted. In October 2008, a severe global financial crisis gripped the whole economy of the world, following from the bankruptcy of Lehman Brothers in the US. In October 2008, a severe global financial crisis gripped the whole economy of the world, following from the bankruptcy of Lehman Brothers in the US. This world economic crisis has affected the growth of our exports and also led to the capital outflows from the Indian economy, leading to the depreciation of the Indian economic growth and crash in the Indian stock market. As a result, industrial and overall growth of the Indian economy started declining. To check the economic slowdown, the government has increased its expenditure. Probably India is very few countries and probably stands uniquely in the history of global development that under the world crisis we are alone able to withstand the crisis and overcome and come out of slowdown, and we could keep smooth functioning of the Indian economy until 2010. Finally, when we sum up, how do we evaluate the performance of monetary policy and fiscal policy functioning in the Indian economy? Monetary policy has performed very well in the post economic reform period from 1991 compared to the pre reform period, whereas the same thing does not hold good with fiscal policy according to some economists. However, even the limited success of monetary policy is not free from some drawbacks. It has failed in achieving control of deficit budgets, fiscal deficits, and most of the times automatic monetization through expansive monetary policy has escalated inflationary pressures than curtailed. Monetary policy in India covers mostly commercial banking sector, and non-banking financial institutions are not adequately covered in the measures. This has led to ineffective outcomes. Even the size of unorganized sector in the finance is very large, which has added further hurdles in the formulation and implementation of monetary policy. As far as fiscal policy in India is concerned, it has a better performance record compared to monetary policy, because we have been progressively able to expand tax revenue generation from the beginning onwards. And after introduction of the GST, if the data shows as per the National Statistical Organization records that our GST collections and tax revenue generation from the states has been very welcome and they are attractive. However, this has not achieved the complete success in reducing income inequalities and disparities in sustainable incomes. Therefore, building up social capabilities and reducing disparities across social sections still remains a challenge.